Right, so in this clip, I'm going to tell you or explain to you what are the two most important financial statements. Pretty much every country, every company in the world will use these statements to explain how they're doing financially. Very important. You'll probably see them in your day-to-day work and perhaps wonder what they are. So in the next 5 minutes, 10 minutes, I'm going to explain what they are, how you can use them, how they're put together, what sort of content we have in these two statements. So these are the two important statements here. Statement of financial position and statement of profit and loss. Now, they sort of have different names. So the statement of financial position, originally that was called the balance sheet, but this changed a few years ago. And now officially it's called the statement of financial position. The statement of profit and loss has always been that name forever really, but occasionally you'll see it called the income statement. A lot of American companies use the name income statement. It's a very American word. You can use either name, but officially the correct name really for these two is these two names here. Now, just to explain briefly what they are, financial position is assets and liabilities. So from a personal point of view, you may have a house, you may have a car, you may have a computer. Those are assets. You may have a bank loan, you may have a mortgage, you may have some other loan. Those are liabilities. So your own personal financial position would be your assets less your liabilities. What is left over is sort of your net assets. That's really how you are financially. Profit and loss account, that's really the revenue from your trading minus the expenses. And then we have, at the bottom of that, we have the profit for the year. So for an individual, that would be things like your salary minus your expenses like rent and food bills and petrol, things like that. At the end of the year, you may have a surplus if your income is bigger than your expenses. Alternatively, you may have a deficit. You may have spent a little bit more than you received. So these are the two main statements here. And what we're going to do is break them down, show you what they are, explain how they're connected. We have a chart here. So we have the two statements here. These are the important statements. And have a look at this. This is important. There is a very strong connection between both of these. They are connected. Now, they're connected through the double entry system that Pacioli invented 500 years ago. They are very strongly connected. If they weren't connected, either of them could be wrong. So that's the first thing to say. Secondly, below them, there's what we call disclosure. That is additional information about either statement. So in both of these statements, you get a number, a big number, and we then break down those numbers into individual items. So that gives you some more information. Now, finally, we have this guy over here, and you may be wondering who, oh, hi. Yeah, hi, Alex.
I was wondering which one of the financial statements is the most important.
Okay, that's probably a difficult question, actually. Yeah, I would say we can't really answer that question. I think they're both maybe equally important. We can't really explain the financial position if we don't have this one. And we can't really explain the financial position if we don't have this one. So basically, really, you can't have one without the other. So I think they're equally important. This guy over here, statement of cash flow, he is probably less important. Generally, we'd say he is less important. I have him a different color. The reason why is he's not really connected through this double entry system. He's a separate statement. He's not connected particularly to these other two guys. That's why he's a different color. Okay. Now, what I'm going to do is show you a statement of financial position for a company. Let's have a look at this. Well, we have the numbers here. These are the totals for the year. And we have this in millions of dollars. So this company is actually quite big. And the total assets for this company is about $200 million. A lot of money. So this is quite a big company. These are all the assets of the company. We have two types of assets: current assets and long-term assets. Current assets are things that become cash quite quickly. We sell the inventory quite quickly and then we get cash. Long-term assets, things like property, we don't sell them very fast and we have them for a number of years. So we'd say they're long-term assets. They're not current assets at the end of the day. That's why we separate them out. Receivables, that's money that's due from customers. Other current assets could be a variety of things. Money that's receivable, that's due to us from different places. And finally, we may just have some cash in the bank account. So that's available straight away. That's definitely a current asset. So this company here, they appear to have about 10 million in the bank. So that's their liquid cash at the year end here, at the year end. So this is only half of the balance sheet. This is only half of the balance sheet. I've just done the assets. Let's do the liabilities. So the liabilities are things that we have to pay to outside people. We have a long-term liability and a short-term liability. Long-term would be something like a long-term bank loan. We have $10 million here. And then short-term could be payables. That's bills that we need to pay the suppliers. And other short-term, other current liabilities, $20 million. So these are the totals here, 60 and 20 for the liabilities. Now, you can see on here, we also have something called equity. Now, what is equity? That is basically equity. That is the owners. That's the owners' capital. That is the investment that the owners have made in the company. This is how much the owners are worth. $120 million they have invested in this company. How did they invest that money? Originally, they bought shares for $10 million. They then have profits accumulated, 70 million. We have a revaluation, so maybe the property went up in value, $20 million. And then share premium. That is the situation where we've issued shares at a profit to another set of shareholders, and we, in a sense, have made a profit on that capital. So the total is $120 million. And as you can see, very importantly, this is effectively the balancing figure here. So 120 plus 20 plus 60, 200. And have a look at this. Magic. This is the same 200, so it balances. This is why it was originally called a balance sheet, because they balanced, okay? They will always balance unless someone has made an enormous error. If they don't balance, there's some really serious problem, and it shouldn't be like that. What I'll do now, I'll show you the other statement. Oh, I'll show you the equation first of all, sorry. So underlying that balance sheet, we have what's called the first accounting equation. This is called it's called the accounting equation sometimes. This is the accounting equation, perhaps. So this equation was drawn up originally by Pacioli 500 years ago. He wrote this in his book. He wrote the accounting equation. And what he said is that we have assets, we have liabilities, and the difference between those is equity. So they must balance. They must be equal. They are equal. It always balances. This is what Pacioli said, and even 500 years later, we still use his equation, and we do literally just call this the accounting equation. It's the equation, okay? So this equation underlies the balance sheet, Let's do the statement of profit or loss now. What we have here, you can see this. We're talking about millions of dollars, so a big company. They have sales of 300 million, and then they have some cost. So all the costs are written down here. And what we see here at the end is the net profit, 30 million. So you can work out immediately what their costs are here. So I think it's 270 million. 300 million income, minus 270, profit is 30. So what costs do we have for most companies? We have the cost of their product, actually making their product, the product that they sell. We have administration. We have distribution costs. We have finance cost. We have tax cost. And then once we've taken those into account, we have the profit. And that is usually what is called the bottom line. Now, as you can see, it's not on the bottom line here. So this is actually an unusual company. And we have this thing here called comprehensive income. Now, that's an unusual situation. It appears that probably we had some extra non-trading income. Maybe the factory, the office was revalued, and we had to take account of that extra 10 million. So the surplus for the year here, or what's called the total comprehensive income, is 40 million. 40 million. So that's the statement of profit and loss and other comprehensive income. Now, what I'll do, I will show you the link between the statement of financial position and the statement of profit and loss. And this is generally called maybe. This is called, this one here is probably called the second accounting equation. And some people call it the clean surplus equation. It's also called clean surplus. Can be either name, can be either name. So what do we have? We have an increase in assets, and that equals the profit for the year, less the dividends. Dividends are money paid out of the company to the shareholders. And then this is the first equation again. So we do the first equation again. And that is just rearranged here. The net assets are assets minus liabilities. That equals equity. This is the first equation written again. This is the second equation. But they're connected. They're connected. Because they're connected, the financial position and the profit and loss are also connected. Okay. Now, what I'm going to do is do this question. We have a little question on the company here. Quite a complicated question, so we'll see if we can achieve it. We may be able to succeed, we may not. Quite a difficult question here. And what I'm going to do is I'm going to get Alex to help me with this and see if we can basically work through this together. So we have a company here, it has 60 million assets, it has liabilities of 20 million. Alex, what do you think is the equity?
I'm a little bit lost with everything.
Okay, so this is the good news, this is the bad news. What's the sort of final position with this company?
To minus the liabilities to the assets.
So that's the assets. If we deduct the liabilities, we have 40, and that's the value of the equity. So this is the equity. Okay, that's good. In the year, we had a profit of 15, and then we distributed, or we gave the owners 5 million. So how much did we retain in the business? How much did we keep in the business?
10,000.
Yeah, okay, so that's good. So we have 15 minus 5. So I think we retained 10 million. So 10 million is the increase in the value of the company. 10 million. Okay, so that's good. Right, this is more difficult. So we have net assets today of 40 million. It increased by 10. What do you think was the net assets last year, Alex?
I'm not really sure.
You're not sure? Okay, okay, fine. Okay, fine. It's a very difficult question. So let's do this. So I understand where Alex is coming from. So let's see this. So today we have 40 million. That's the assets, the net assets today. Net assets today. That was an increase of 10 million from last year. So therefore, we had net assets of 30 million last year. That's last year. Right, okay. So last year the net assets were 30 million. The liabilities were 10 million. That's million. What do you think the total assets were last year, if that's the case?
40.
Excellent. Okay, fantastic. So we have net assets of 30 and we have liabilities of 10. So we have total assets of 40 million here. That's the total assets. Well, okay. Thank you ever so much, Alex. That was really, really good because this is a hard thing to do at the best of times. So well done, Alex. Thank you for that. That was great.